Hello students, my name is Shesi George, your professional accounting teacher. In this video, we are going to look at this case study by answering the part B of the question. That is, the part B says that prepare a cash flow statement for 2012, 2013, and 2014. In the first video, you have seen how to prepare profitability statement. So let us prepare our cash flow statement, which I will call the cash budgets. Okay, cash budgets. All right, then let us get started. So you first write the name of the business, Ologojulo Nigerian Enterprises. So in the first video where we prepare profitability statements, the question has been read, but now we want to prepare the cash flow statement. So you write cash flow statement according to the requirements 2012, 2013, and 2014. That is the required year to be prepared. So students should take note of that. Now, we are going to start with this information here. The company policy on sales is to ensure that sales are collected as follows: a cash sales of 40% of the monthly sales. Okay, so let us go to the monthly sales. This is the monthly sales. The monthly sales has been given, but our cash flow statement is based on a yearly basis. Okay, it is on a yearly basis. Take note of that. So what you will do is to take 40% of each monthly sales, okay, then you multiply by what? By 12. So for 2012, we have 42 multiplied by 40, which is the cash sales, okay. So you have cash sales, okay. Then this is 40% of the monthly sales, then you multiply by 12, and that is 2160, okay. Then you do for 2013. 2013 is 48, so you have 4008 multiplied by 40% times 12. That's 23. That's 23040. Then for 2014, that's 72 multiplied by 40% times 12. Okay, that is 34,560. All right, so that is 34,560. Okay. Then the B part, so this part has been done. The B part says that the balance of the month's sales is to be collected in the month following the sales. The balance of the month's sales is to be collected. So in that case, we are going to do something here. You will multiply each of these sales by 12. All right, you will remove, or let's take the 60%. So we take 60% because 40% is assumed to be cash sales. It means the 60% is on credit sales and is to be paid the following month. Okay, 60% is to be paid the following month. So to do that, you are going to have what we call the cash analysis, and this is the format. So for each monthly sales, we are going to take the 60% and multiply by 12. All right, so let's do that. So for 2010, let's take 60%. That is 34 multiplied by 6 times 12, and that gives 2448. Okay, 24480. All right. So all the 60% credit sales has been gotten, and we are told that for 2010, so the 2010 is out of it. If you divide this by 12, you will divide this by 12. It means 11 months will be recovered in 2011. Then the 12 months will be recovered in 2011. And 2011 is not part of the required year, which is 2012, 13 to 14. Okay, so for 2011, if you divide this by 12, the the January will be recovered in February like that. So the one of December 2012 will be recovered. Sorry, the one of November 2011 will be recovered in 2012. In 2012, based, the question says the balance of month sales is to be collected in the month following sales. Okay, is to be collected following sales. So if December, the one in December 2012, let's say 2011, December will be collected in January 2011. So you have 12 months for 2012. Then the last sales, which is December 2012, will be collected in 2013, while the remaining 11 will be collected in 2013. Then the last sales, December 2013, will be collected in 2014, in that sequence. Okay, I will repeat. The balance of the month sales is to be collected in the month following the sales. Okay, let's take for example December 2011 is a credit sales. The credit sales will be collected in 2012. That's what it means. While from January to November will be collected in 2012. So when it gets to December 2012, that monthly sales will be collected in the month, that's January 2013. So from January to November 2013 will be collected this year, that 2013. But the one of December 2013 will be collected in 2014, and so on and so forth. Okay, so from the analysis, we'll start from 2012. 2011. So let's divide this by 12. So we have divided by 12, which is the monthly is 2160. So for December, the December 2011 will be collected in 2012. Okay, then the one of 2012, you divide this by 12, that is 3024 divided by 12. Then this is the one for December. So if the one for December will be collected in 2013, all right, sorry, that's 2013. Then the remaining balance will be collected in 2012. So let us, this minus this, what do you have? Okay, that is 3024 minus answer. That is 2727720. Okay, all right. Now, the one of these, the December 2000, you divide by 12, which is 34560 divided by 12. That is 288, which will be collected in 2014. We collected in 2014. Then the balance, just you can multiply by 11. Will be collected in 2013. Okay, 680. Then the one for this for 2014 will be collected in 2015. So let's divide by 12. 51,840 divided by 12, which is 4,320. Okay, 4,320. Then we have times 11, and that is 4 times 11, 4,7,520. So we can now add. This is total receivables, cash from receivables. So let us add this. I will add, then we add 280 plus 47520. So that is 5,400. Then this is the ASAT 2014. This is our total receivable. That's the debtor. Total receivable up to 2014. So take note of that. So we now transfer this to our workings as a collection from receivable. Collection from receivables, okay, which is 29880, then 34200, then we have 5400. Okay, all right, now let's go to the next topic. Then they said the policy on purchases is in agreement with the supplier policy, which is to pay for all supplies in the months following. So that is, we have payables, payments to payables. Okay, month following. So this, the same principle we apply. So let us look at our purchases analysis. So we have purchases analysis. So we start from 2010. So we have, so I'll use this 2010, 2011, 2012, 2013, then we have 2014. Okay, so we have the 100% multiplied by 12. So for the purchases, we have 200. That's just say 2,000 multiply, because we are working in thousands, by 12. That's 24. So we have 24,000. For purchases, this is the total. So for 2012, we divide this by, let's divide. So we don't have any business with this. We divide this by 12. So we have 28800 divided by 12. That is 24. And that 24 will be paid, the one of December will be paid in 2012. So you now say 24 times 11. Okay, this one is gone. Then for this, we divide, because the remaining balance would have been paid in 2011. All right. So for 2012, we have 33600 divided by 12. That is 28, and that will be paid in 2013 to the one of December. 2800. Then you have 2800 times 12. Oh, sorry. Divided by 12. 2800 times 11. That is 3800. Okay. Then we have 38400 divided by 12. So the one of December 2013 will be paid in 2014, okay, which is 3200. Then the balance, that is times 11, must have been paid in that year of 2011, 35200. Then 57600 divided by 12, which is 48, will be paid in 2015. 48, okay, take note of this. But the balance, that is times 11, that is 52800. All right, so this one is for 11 months, which would have been paid, which will be paid in 2014. Then the December 2014 will be paid in January 2015. Same thing for 2012, the December, this is the December one, which will be paid in 2013 according to the policy of the question. So let us add. So when you add this, what do you have? We have 24 plus 3800, and that will give you 33200. Then for this we have what do you have? 28 plus 35200, which is 38,000. Okay, for this will be 32 plus 52,800, and that will give you 56,000. Okay, then so our payable will be 33,200, 38,000, and 56,000. Okay, now let's continue with the question. Now when you go to the next aspect, okay, that one has been done. This one is for the preparation of what's it called, profitability statement. So they said monthly salary, so we can pick from our profitability statements. So we have salaries, rents, just apply the same figure, and cash expenses. Okay, so we now pick those figures. So for salary we have 5,160, you multiply by 12, 160, 5760. For rents, I think is 1,200. Then for expenses we have 2,880, 3,360, then 4,320. Okay, then we are told that a vehicle was purchased. The vehicle was purchased for 5 million, all right, and it was paid in September 2013. So purchase is an outflow. Purchase of vehicle, which is 5 million. It was in 2013. So 5M. Okay. All right. Now, having done this, what is left behind? Then you need to take the total. This is total inflow, cash inflow. We add the total, then this is total outflow. We add this, so we have our net cash flow. All right, so let us add this. So when you add, it will give you these figures. You can use your calculator to check. When you add all this, it gives, when you add, it gives this, it gives, then you now subtract. Let's say this is A and this is B. So our net inflow will be A minus B. And what do you have? Okay, so the net cash flow has been calculated by subtracting this from this, this from this, this from this. Okay, so the net cash flow has been calculated. You can use your calculator to do that. Then we have our opening balance of cash, opening cash balance brought forward. Okay, and that is 4 million. So our cash balance as at 31st December 2011, that's the opening balance, which is 4 million. Then we add, when you add to this, it gives 116. Then this is closing balance. This closing balance, carry forward. Then this will come to this place, 1600. So when you add this, let us add. When you add, that is 4520 plus 11600. So we have 1620. Then this goes to this 16120. So when you add plus 17, so what do you have? You have 1760 plus 16120, and this is 3800. All right, now this is cash statement has been prepared. Okay, the cash flow statement has been prepared. All right. Okay, so the C part says that determine and comment on the liquidity ratio for 2014. The liquidity ratio for 2014. So what is current ratio? That's the C part. Current. So we have current ratio. Current ratio is equals to current assets all over current liability ratio 1. And our current assets there is our, for 2019, that's our cash. This is our cash balance, 33800, plus the debtor in our analysis. This is our debtor in the analysis. That is 4. Don't forget, all these are in thousands. 320 plus the opening stock, closing stock in the in our profitability statements, plus this. That's the closing inventory. All right. In our profitability statements, where we prepared this in the first video. Okay, so which is 1440 all over creditors. And what is our creditor? This is our creditor in our purchases payable. So our creditor is 4800. So when you manipulate this, what do you have? When you manipulate this, you have 33800 plus 4320 plus 1140. We have 31440, and that is equals to, that will give you 39560 all over 480. This is ratio 1. So when we divide by 4800 ratio 1, it will give you 8.242 ratio 1. Okay, 8.242 ratio 1. All right. Then the last part of the question says we should compute the gearing ratio. we should compute the GR ratio, which is the GR ratio is the long-term liability all over equity, and is nothing but the capital of the company inclusive reserve, a mix of 30% and debts, long-term debts. Okay, and the debt is 30% of 15 million all over 70% of that same 15 million. Okay, when you cut, so what do you have, which is 3, then times 100 over 1 times 100 over 1. Okay, so what do you have? That is 30 times 100, 30 times 100 divided by 70, and that will give you 42.857%. Okay, so the question is so long, and if you don't understand, please, you can replay the video. Thanks for watching. Bye.